Hello guys, I hope you're doing good. Today I'll be discussing SIPs or systematic investment plans. SIP is a term that has been discussed extensively by the investors and bankers, so let's just delve into it right away. What is an SIP? An SIP is an investment vehicle offered by many mutual funds to investors, allowing them to invest small amounts periodically instead of lump sums. The frequency of investment is usually weekly, monthly, or quarterly. In SIPs, a fixed amount of money is debited by the investors in bank accounts periodically and invested in a specified mutual fund. The investor is allocated a number of units according to the current net asset value. Every time a sum is invested, more units are added to the investor's account. Let's move towards the types of SIPs. Flexible SIP. Flexible SIP allows you to adjust the SIP amount based on your financial and market conditions. There is a pre-decided formula regarding the market conditions which enables the investors to invest more when the markets are falling and go for a lower SIP amount when markets are high. Step-up SIP. Step-up or top-up SIP allows you to increase the SIP amount at fixed intervals. For instance, you might start investing with Rs 10,000 SIP in a mutual fund scheme of your choice and instruct the fund house to increase the SIP amount by Rs 1,000 after every 6 months. As per your request, after the first 6 months of investing Rs 10,000 per month, the SIP amount will be increased to Rs 11,000 per month. It will again increase by Rs 1,000 per month from the 13th month. Step-up SIP can be an excellent option for salaried employees expecting a raise shortly. Perpetual SIP. Perpetual SIP is one of the best options available in the systematic investment spectrum as it is linked to every SIP investor. When you start an SIP, the SIP mandate requires you to mention the start and end date for the same. While investors generally mention the starting date, most do not fill in the ending date. Every SIP with no end date mentioned in the mandate turns into a perpetual SIP, which is deemed to run until 2099. However, you do get the option to stop the SIP by submitting a written application to the fund house. If you only want to invest for a fixed tenure, make sure you enter the SIP end date as well. Trigger SIP. With the trigger SIP, you get to set a trigger for your SIP investment. For instance, you can mention that your SIP amount should be withdrawn from a bank account and used to purchase units of the selected scheme only if the net asset value of the scheme falls to a certain level. You get other trigger options such as specific dates and even levels of an index like Nifty or Sensex. But this option is recommended only for experienced investors who have the knowledge and experience to set such triggers effectively. After discussing SIP and its types, let's look at the advantages offered by SIP. SIP brings more discipline to your investments and savings. People often complain about not being able to save money. By choosing the SIP route, you get to invest in regular intervals every month that will automatically translate into savings before you spend your money. Slowly but steadily, it brings financial discipline and also helps in realizing the returns later. Start with small amounts. With SIP, you get to start investing with as little as INR 500 a month. If your earnings are not very high or your savings are low, you can still take advantage of or be a part of the growth of the Indian stock market by choosing to invest in SIP plans in various mutual funds. Grab the benefit of compounding. When you invest in an SIP, the monthly returns derived from the SIP will be reinvested in your investment amount until maturity. So with time, your investment amount is exposed to the impact of compounding and helps you with exponential growth. Stop anytime you want. The majority of the SIPs do not charge any penalty or fine if you want to stop the plan at any moment. All you have to do is go to your Demat account and opt out of the plan. This is one advantage that traditional investments like fixed deposits, recurring deposits do not provide. Skip if funds are tight. Sometimes for various reasons, you might not have enough funds in a bank account that can be used for investing in SIP. Do not worry. SIPs allow you to skip a month without any charges or fines. You can come back later and keep investing as you did every month, unlike an RD or an FD. Disadvantages of SIPs. SIP investments don't work in bullish markets or when market rises up over time. When market goes up and keeps growing over time, the units bought each time are at higher value than the previous one, which can ultimately bring the average value up compared to the lump sum investment at the beginning. Tax saver mutual fund schemes lock your money for 3 years. Once you invest through SIP, all of your investment is locked individually for 3 years from the date of investment. Therefore, if you pay your initial installment in January 2022, it will be locked until January 2025, and then the installments paid in February 2022 are locked until February 2025, and so forth. Is SIP better than FD? Depending on your financial goals, you can decide if a mutual fund, systematic investment plan, or a fixed deposit is the right choice. Each investment scheme has its benefits. While an SIP or mutual fund may give you more interest, an FD is a more secure option that offers assured returns. If you like this video, then don't forget to share and subscribe. Thanks for watching.